morning. We are Mortgage Pros 411. I am Audrey Boisno here with my co-host Kevin Casey. And today we are joined by Broadway star Barry Habib. Welcome, Barry. How are you?
Oh, hey, Audrey. Hey, Kevin. Always great to be with you guys. Hope everybody's doing well out there.
Barry, nothing could be better. Everything is perfect. Thanks for asking. So we are going to start with just a couple of announcements. First of all, make sure if you missed last week's show, we had Joe Weber talking about insurance, which is a pressing issue from one end of the country to the next. So it's on our YouTube channel. Thank you to everybody who signed up and subscribed. Please keep doing that and share it with your friends. But it was really a dive into what's going on, what to do. Thank God, no government shutdown. So we still have flood insurance, but we always have private flood insurance. Don't forget that. And then NMLS Live, it is NMLS season. Make sure you get your live class, get your NMLS done, for God's sake. Okay, so Kevin and I are teaching next Monday at the Sausalito Yacht Club, the most beautiful NMLS class in the country, I would guess. Right on the water, looking over San Francisco. That's October 9th. And then October 11th, I'll be in Fresno, California. I'm sure it's lovely there too. So with that being said, Barry, let's start with the JOLTS report that we got today. What is the JOLTS report? Job openings, labor turnover survey. How could that turn everything to crap so fast? What happened?
Well, it was a combination of things. That was a surprise. The last report, and we've been trending down. We've been going from roughly 12 million last year of openings that have been posted to about 8.9 million. So you've seen a trajectory lower, and we're hoping that would continue. But that jumped by 600,000. Now, the vast majority of them came from services for private businesses. And the thing about this is that you have to understand how the JOLTS report is constructed. It isn't constructed on a national level. It is constructed by taking each state's individual reports, and then you pile them together. So California, Nevada, you're going to add all those up all across the country. But the thing is that we believe this report to be highly overstated, because if you're trying to hire someone in today's world, especially in business services, you're not just limited to the proximity of your office. That's pre-pandemic stuff. Since then, with work from anywhere, you might be looking for labor costs that might be less expensive. So if you have a business in California, you might be looking in Nevada, you might be looking in Arkansas. So if you're going to post that same job in 8 different states, well, then it can greatly overstate, because each one of those states is going to roll up that job and it's going to be counted. And then in the aggregate, it's counted 8 times. You also are seeing the same job given different titles for the same job so that you can get keyword searches. And what that's done is that's also created an overstatement. So although this number is highly overstated, you could certainly debate that, you can't debate the fact that the number increased on a month-over-month basis. Could it be an anomaly? It's for the month of August. Could we see September move back? It's quite possible. But the market didn't like that, because we know how concerned about the job market this Fed is. And of course, as I said, the combination of things. So you had Michelle Bowman, who's a Fed governor. Now, she's a lawyer. She's not an economist, but she says we need at least 2 more Fed rate hikes. Then you had Loretta Mester, who's the Cleveland Fed president. She says we need another Fed rate hike. So these are things that the bond market is not liking. Stock market clearly is taking it on the chin as well now. But the stock market was very overvalued. But I think we're reaching at least some point of exhaustion in yields, just taking this parabolic rise now. If you take a look at the 10-year Treasury, it has moved up really sharply. Now, almost 4.8% on the 10-year Treasury. I could glance over it and tell you exactly where it is right now.
And it's, need to know the exact number.
4.797. So it is close enough to 4.8%. Yeah, it's right there. That's a big move. Could we hit 5% of the 10-year Treasury? It's quite possible. The only thing is that we're reaching a certain level of exhaustion. A lot's going to depend on Friday's number from the BLS for jobs for the month of September. So this will be a very telling story, because the Fed's been hanging their hat on the job report, and they look at these numbers, but they don't look deeply. I mean, a lot of cracks in the job report, all the revisions that continue to happen, the fact that we're losing full-time instead of and putting in more part-time jobs. So it looks like job growth, but it's the wrong kind. Hours worked being cut by a half an hour a week during the course of this year. These are important things that show some cracks, but we've yet to see like a really crappy headline number that comes out without revisions, so we've seen numbers come out, but then they get revised 2 months later and it's like, it's old news. Everybody trades on that first. We need a really crappy number to get the Fed's attention.
Well, I very politely have suggested we change the BLS jobs report to the BS jobs report because it's such a bunch of garbage.
Yeah.
But, nobody has taken me up on that. And while we're at it, has somebody written a nice handwritten note to JOLTS asking them to please revise the way that they put their little report together so it isn't such a disaster? I mean,
It's the best that they can do because they don't know, and it's very hard on a month over month basis to see okay, so can we match and sort which jobs were posted multiple times? Remember, you're talking about 9 million entries, so
right.
it's not something that's easy to aggregate at the end of the month. They just take the number from the state and they put it in. So it's something that we know overstates it, but the Fed is not looking at that and looking at it that granular. They're just taking the headline number. Remember, these are some, Jerome Powell, Michelle Bowman, others. They're lawyers. They're not trained economists. They don't look very deep. They just look at the headline number.
Yeah, at least we've got really great qualified people running our financial system. So why is it when we have Michelle Bowman and Loretta Mester saying, more increases, but you have Michael Barr and Raphael Bostic saying, okay, that's enough. Why don't they like either cancel each other out or like why doesn't the okay hold drown out the keep goings? Like, like they seem to glob onto the media and the market seems to glob onto the worst case news scenario and then go with that. I mean, it's
That's
so
always been the
frustrating.
case. The media is always going to, they're going to want the most clickbait they can, and negativity is what sells. They know very well how our brain works. They know about the amygdala in our brain, and the
Mhm.
amygdala is a safety mechanism that, when you have something that potentially could cause fear or cause problem or injury,
You pay
your brain
attention.
pays very close attention to that,
Yep.
and it also freezes and memorizes that. So these the people in the media know that very well, and they're gonna try and always portray scary, terrifying things or bad news. That's what they do. The thing of it is that when you see the Fed, they've really kept the ranks very close, and they have yet to dissent amongst each other. But I think that you point out something very interesting, Audrey, and that there's now becoming some pretty varying views when you talk about two more rate hikes or no rate hikes. There is some differences there. And I imagine that we potentially could see some dissension, especially if you got the Fed to go two more rate hikes. I think you'd have somebody like a Bostic, a Goolsbee, a Barr, certainly John Williams protest if that was the way to go. So you have like four members of the Fed, I think, that would at that point raise their hand. One more, they probably would say, but two more, I think that you'd finally see some dissension and some protesting there, rightfully so. They should have not raised where they've gone. I mean, they created the banking credit. They're all doing this because they put us in this mess to begin with. They continue to look out the rearview mirror. People don't know how to analyze these numbers. I was just before this listening to the Apartment List, and Apartment List has the right ideas, but they just don't have the right data. Smart people don't know how to analyze this data. It's very, very tricky and confusing. The fact of the matter is that core CPI right now is showing a level. I could show it to you. It's kind of something that's very interesting to see.
Yeah,
So
I'd like to see it,
if
but
you
I'm weird
allow
that
me to
way.
share, I will
Oh, geez,
pull up
Louise.
the
Oh, the
chart, and
sharing.
I
Good
will do
God.
that.
We always go through this sharing dilemma. Hang on. At least I know how now. So that's something. All right, you should be good.
So let's share and let's kind of take a quick look together. So this gives you blended rents, and that's what's important to look at, because Apartment List is going to show you new rents that are going down year over year 1.2%, but not all rents are new rents. In fact, most are renewal rents.
Mhm.
So renewal rents are going up at about 4.5% a year. You blend the two together, and this is the number you want to go with, 3.1%. Now, again, Apartment List, I was listening to them, they had the wrong numbers for inflation as well. The way that it's reported in the CPI report is it is shown as 7.3% year over year. PCE, the other reports show 7.4. They tend to track pretty close to each other. So why are we going up at 3.1, but CPI is showing 7.3? It's because they don't take the current number. They take the last 12 months and they average them. And if you average the last 12 months, you see we'd be right here, right? So, no, pretty simple, right? Take 12 months, boom, midpoint's about here. So that's why they're saying 7.3. But this is looking out the rearview mirror. This is at least looking at the side window of where we are currently. Now, why is this so important? And again, listening to Apartment List was almost comical today because they said 2/3 of headline CPI is shelter. It's not. It's approximately 33%, but on core CPI, it's 43.7%. So it's nowhere near the numbers that they were saying. So let's get the exact numbers. It's 43.7% of core. Why is that important? So if you take what is being considered and contemplated by the Fed versus what's in real life happening, that difference between 7.3 and 3.1, you can do the math, it's 4.2%. You multiply that by the weighting within core CPI, and you can see that while the Fed is saying, hey, you know what, we are here at 4.3% core CPI, and that is way too high, they're not contemplating the fact that this is looking in the rearview mirror. The lag effect, and we could do the math together. 7.3 minus 3.1 is 4.2 times 0.437. That's 1.8% overstatement, which brings you to a real CPI rate of 2.5. Now, I know that core CPI is the Fed's target at 2, but this is pretty darn close. It's certainly not as far off as they think it is. You wouldn't want 2 more rate hikes here, Michelle Bowman. You wouldn't want another one here, Loretta Mouse. You just need a little bit of patience. Look, we are all reasonable people here. And if you're driving down the road and you're going at a pretty good clip, if in the distance you saw a brick wall, you would, in all likelihood, start to tap on the brakes well before you hit the brick wall, but not the Fed. The Fed is waiting till it hits that 2% brick wall and then tap on the brakes. But that's wrong because, as I said to you, this is the side window. Where are we today? This is the rear view mirror where we were, but the trajectory is the front windshield of where we're going. So you don't want to wait till you get to 2% and then hit the brakes. You got to start hitting the brakes way before that so you don't crash. This is what they always do. And it's what they did. The reason we're in this mess, yes, it was the administration spending was big culprit on some of this stuff. Let's call it what it is. I'm not getting political, it's just factual that you add, trillions plural of dollars, and it's going to be inflationary. So when you take a look at what the Fed should have done is at least contemplated that, but they didn't. In 2021, in the face of all of this stimulus that was coming out from the government, the Fed should have looked out the front windshield, but they didn't. You know what they did? In 2021, you had Jerome Powell saying we're not even thinking about raising rates or stopping QE. He was saying that we're going to have to extend QE and keep rates at 0 for an extended period of time. He said if there's any inflationary, it's transitory. All big screw ups. The other members of the Fed were singing the same song, drinking the same Kool-Aid. And then you have our Treasury Secretary at the same time, Janet Yellen, screaming from the rooftops, this is the time to go big. So why did they do that? Well, it's because they were looking in the rearview mirror. Let's look at inflation at the time. They thought inflation was low, but that was weighed down. Remember, a lot of the inflation weighting comes from shelter. And remember, shelter is not home prices. Home prices came out of the CPI and PCE equations in 1976. Jimmy Carter did that because he wanted to try and make inflation look better. So they took home prices out of it. And by doing so, they replaced it with rents. And that's where it's been since 1976. So it's rents and owner's equivalent rents, which is the vast majority of what's in it. And back in 2021, when everybody was screaming that we need more inflation and we're not even thinking about hiking rates, the average going backwards was 2.5% of shelter costs. That was pretty attractive. It kept inflation near 2%, and they felt good about that. However, in real time, the blue line, I refer to it as looking at the side window to see where you are currently. They were going up at an 8% clip. The Fed ignored this, but then they really made the boo-boo of ignoring the front windshield, which is the trajectory going this way. And they put us in this mess.
Yep.
So in other words, they waited until here, till we crashed, till March of 2022 to stop QE and to get off a zero interest rate policy. They waited till we were here to hit the brakes. We already crashed into the brick wall and they created all this inflation. So they're making the same mistake that they made here again, because instead of looking at the blue line and trajectory, they're looking at the gold line and the rear view mirror. So this is clearly a, you know, it's a problem because you have, look, I don't doubt that they're highly intelligent people, but if someone were to be facing a court trial that was very important, I don't think I'd want an economist getting up and representing me. I'd want a lawyer. And for the largest economy in the world, pricing the most important commodity in the world, which is the price of money, you probably don't want a lawyer or lawyers making these decisions. You probably want trained economists with some business experience making them. But unfortunately, this is not what we have right now.
I think, yeah, business experience, that would be very compelling idea for them to embrace, wouldn't it? So let's talk about PCE last week. It came in, the headline was a little higher, but core was better. Do you want to walk us through that?
The core number was very good because core strips out food and energy. So that came in at like 0.1% for the month. That's what you need. You know, when you take a look at these inflation numbers for the past 6 months, they're attractive on the core. The headline number, which has gasoline prices, energy prices, we've seen West Texas Intermediate, known as WTI, oil prices, move rather significantly higher. You know, they were just at 70 and they're gone to around 90. They just sliced a little bit below 90, but they're hovering around there. We could check and see where that is. But, you know, it was up to 95. This is causing energy price to go up. So the reason why the Fed tends to focus on the core is because they know that the consumer feels headline inflation, but they don't have the controls in place to alter that food or energy module. Because if the Fed hikes rates or cuts rates, it's not going to change what OPEC does or oil production from Saudi Arabia or Russia. However, also food prices fall into that category because oftentimes food is governed by things like weather, you know. So, you know, the Fed's not powerful enough to hike rates and make weather better. So they try to say we want to focus on the core because that's what they believe monetary policy can influence. I know a lot of people don't really get that portion of it, but this is why core is so important because it's what the Fed can influence with monetary policy. And the numbers are good, 0.1%. I mean, it needs to come in low. It needs to come in at 0.16% average for 12 months is 2% a year. That's a really freaking low number.
Right.
So it's hard to get there. I think the Fed should have some degree of latitude to say, okay, 2%, 2.5% inflation, good enough. You know, we are there. And then you, of course, you've already destroyed the banking system, what they did with the bank failures. You've already put people in a position where, you know, anyone with an adjustable type loan in the commercial real estate field is really reeling and suffering. They've caused a lot of issues and problems for individuals. So, you know, and one of the things that we need is more supply and construction, right?
Yeah.
And when interest rates are more favorable, builders can, you know, they call it penciling out. In other words, when you do the math on it, it makes sense. But at higher levels of interest, they're actually hurting their own cause. Think about the irony of this, but, you know, the Fed plays checkers. They don't play chess. So they look at one move. They don't look like 3 steps down the line. So by hiking rates so dramatically, they now put a pause on people to borrow loans for construction. They've also constrained credit because the banking system has had to redeem those people pulling monies out of deposit accounts, which the bank could use to lend, and saying, hey, you're paying me 0.5%. Screw you, bank. I'm going to take that money and I'm going to put it into a money market and get 5%.
Right.
Many of us listening have done this. I've done it. Okay. So when we do these types of things, that's not insignificant. It means the bank has to give us back our money. Where are they going to get that money from? They can't get it from the person they gave the car loan to. They can't get it from the person that they gave the business loan to. They can't, excuse me, let me knock on you, give me my money. You can't do that. So you are forced to take other areas you've invested that are more liquid, but give you a higher yield than the 0.5% you gave the depositor, like mortgage-backed securities and treasuries, and you have to sell or redeem those. Well, that causes rates to escalate as well. So they have caused all these problems. And now the bank is saying, I don't have the liquidity because I'm trying to raise money to make up for these redemptions. I'm not getting the inflow of deposits. I have to constrain my lending. So with lending being tighter, that also makes it a premium to borrow money. So if you're a builder, it costs you a lot more money to borrow. So you say the numbers don't make sense on a spreadsheet. At this high level of borrowing, the carrying costs eat into my profits so much, I'm just going to wait until rates come down. I'm not going to build. Now, what does that do? That pushes home values up. It pushes
Even
rents
more.
up because there's less rental units coming on the market and rents are going to go into the inflation numbers. So they are, again, they're playing checkers. They're not playing chess.
Yeah,
They're
it'll also
getting-
help hurt the stock market because as rates go into the fives, people are looking at the returns on their stock exchange and say, well, it's going to return 5%, but there's a risk. Why don't I just take the guarantee of the 5% in a CD or treasury? And so you're going to see money coming out of the stock market and into CDs and treasuries.
You're already seeing it, Kevin. You're
Yeah.
seeing it. You see what the stock market's taking a beating every day is because
Every day. Yeah.
the Fed is causing this. Now, for us, from the mortgage perspective, and look, I don't want anybody to have a hard time. Look, yeah, strictly on paper, from the mortgage perspective, yeah, we do need to see the job numbers get weaker, but we pray for those people that would lose their jobs, right? I mean, we don't want to see any harm being done to anybody. And the same thing in the stock market. We don't want people lose money in stocks, but when those things happen, if the stock market really starts to take a hit, this is the big one because this changes behaviors. When people look at their statements and they see their statements coming in, oh, I lost money, I lost money, I lost money in my mutual funds, that wealth effect weighs on you psychologically. So your spending decisions drastically change. We've all been there. We've all been there. You don't feel as comfortable making the big purchases, going as much, and that slows the economy. Now, the Fed does know these things. And they know that by keeping rates up at levels that are like this, that are going to be competitive, as you say, Kevin, with stock market returns, and people will sit on the sidelines, by bringing the stock market values down, they know that that wealth effect gets taken away from people, and they know that that slows the economy. Remember, Jerome Powell said this, the economy needs to feel pain for his screw up.
Well, that's great. Okay, so I want to take a moment. So we averted a government shutdown, but it was just a delay to November 17th. So here we go again. And we had our debt rating, our credit rating cut, et cetera. There were a number of reasons that we didn't have the lower rates that we expected in the summer. Why don't you walk us through how that played out and all that goes into it? That we have all these unexpected things that come up. You can't forecast exactly. So just walk us through all of
So
that.
yeah, so we'll start with the shutdown that was averted. I thought that Kevin McCarthy did a really good job, and I don't envy his position. I don't like what Matt Gaetz is doing. I'm here in Florida, and I was lucky enough. There was like a Zoom call that was a very exclusive Zoom call with like 15 people on it. I was one of the 15 people with Matt Gaetz, and I confronted him dead on, and I was like, why would you do, I said, ideologically, I think everybody agrees with you that we have to slow down the spending. I think that's smart, right? I really do. I mean, I believe in that. I think that we have to make.
I think everybody would agree at that.
Yeah.
Spending levels crazy.
But I said, but the way you're approaching this, and I didn't say these words, but listen, it's like a 4-year-old throwing a tantrum, right? So the way you're approaching this doesn't seem like it's going to be viewed well in the eyes of the public. Because especially the media, which is going to have a slant against the party that you're with anyway, and they're going to have a field day with this, blaming the shutdown on your party. So why would you do something like that? And really, he very ill-equipped to answer that question, and very ill-equipped because they asked him some questions that have something to do with the economy. You could just tell he's out of his league in understanding the economy. So once again, lawyers who do this stuff, it was a bit scary for me, so I don't like what is happening. I don't like that. I don't want to see us shut the government down. I want us to be more responsible on spending. But the right way to do it, in my opinion, is look, let's make sure that once you're in a position where you have some authority there and you can make some changes that are, people vote you into doing, then you make those changes when people vote you into the position to do so. That's, in my humble opinion, the right way. Now, you did ask the question right after that and saying, okay, so why did we see rates move up so much? And it's what's interesting about this, Audrey, is that I was dead wrong. I thought that we would see lower rates over the summer because of something that we've always seen throughout history. I remember as far back as when I first started looking at this stuff economically, that inflation governs long-term interest rates. That's just the way it's always been. And throughout the years, we've made some extraordinary calls for the last 25 years on the market. And then we said, hey, look, we see inflation coming down from its level of, it was 9%. When I said in the summer of 2023, it would be 3%, people thought I had three heads. What do you mean? I mean, and I was on, John Walden's SIC everywhere. I talked about it everywhere, and everybody thought I was freaking crazy. That, and obviously saying the housing market was going to be strong. Well, we were dead on housing. And guess what? In June of 2023, we hit exactly 3% on inflation. But I also said that mortgage rates would be in the fives because of that. Because, I mean, just to think about it, inflation's at 3, figure about 2% above that. Maybe the core is a little higher, so figure 2% above the core. So you'd see mortgage rates below 6%. That seemed to make a lot of sense to me. So I said, we should be below 6%. Boy, was I wrong. We went the other way. We're above 7%. So what happened there? So one was, as I mentioned, banks had to raise capital because deposits fleeing going into money markets. That caused a liquidation in mortgage-backed securities. Then you had the banking crisis, which was SVB and Signature, as well as First Republic. I mean, very close to where you guys' backyard is.
It is our yard.
Yeah. And then now those bank failures were taken over by the FDIC. So when that was taken over, that paper that they held in mortgage-backed securities and treasuries is up for sale. So that's additional supply, additional selling. The debt ceiling deal that you had mentioned, Audrey, that to appease that, there was an extra $270 billion in spending. Now, when you say, okay, we're going to spend $270 billion more, that's an enormous sum of money, by the way. You don't say, okay, we'll write a check for it because we have the money in our savings. There is no savings. There's no checking that we can write it out of. What you have to do is you actually have to go out and borrow it. And the way you borrow it is by selling treasuries. And guess what that is? More supply. So that hurt us over the summer. And then Fitch's credit downgrade certainly didn't help matters. So you see all of these things come together in a confluence of factors. And even though inflation was heading in the right direction, the added supply and the credit rating downgrade caused long-term rates like mortgage rates to move in the opposite direction. These things are clearly very, very trying and frustrating for us in the mortgage industry who've been accustomed to seeing inflation come down and mortgage rates respond in kind.
Right. Right. Well, I just want to say congratulations on being the only person who does forecasts that I've ever seen who actually acknowledged that they didn't nail it. I mean, remarkable. I'm not joking. Like, it drives me nuts. And we have been talking about this because we've seen some crazy prognostications in the last few years. I mean, 2 years ago, we were told, oh, you'll see the lowest rates you've ever seen. This is coming off of 2.5% rates by the end of the year, beginning of next year. Okay, we literally went the opposite direction. So thank you for explaining what the deal is. But we have a little ditty that we've been singing around here for 3.5 years, Kevin? Yes. If you see a rate you like, lock it in. Yep, that's it, kids. I mean, you can forecast your brains out, but if suddenly a country invades another country, if we suddenly have a debt ceiling crisis, if we have a banking crisis that nobody really saw coming, it all goes to crap overnight. So with that being said, we have to really be advising our clients to take the moment and what we have to work with now. And yes, do we all think the rates are going to come down? Yes. But to where? No idea. I mean, who in the hell ever thought we were going this high, right?
I know. You just have to be careful with that, Audrey, because, that strategy would have been working very much against us for a long period of time. And look, for most of the past 40 years, as we've seen the trend in bond prices to come down. So I think that, yes, at this point in time where you are, should be very cautious, clearly. But you do have to take it day by day as it comes as well, because I originated loans for a long time. I know how fickle my clients were. I mean, you'd lock them in and then the rate drops a little bit and they're like, okay, well, I'm going to go elsewhere. I want to renegotiate it's a pain in the butt, you know. So
Right.
this is not, we earn the money we make in this business, right? Because it's not easy. You know, we want to definitely get the best deal for our customers, but to just lock everything in at the same time, I don't know that that's the right approach either. I think that that's too much to the extreme. I think we need to kind of evaluate where the market is and where it's going carefully. Now that's not very easy to do. It's a very difficult thing to do, and we're not always going to be right. But I think the more we can provide advice, the more value that we obtain,
Yes.
and we separate ourselves from, you know, an automated system, or, you know, somebody that just blindly takes applications.
If you you have more to lose than to gain right now, is what we've been seeing. And so again, this whole idea that you're going to chase the lowest rate is not reasonable in this market at all, in my opinion. So again, like I've talked, I mean, I know what's going on in the market just as, I mean, like a lot, right? So I explain this to my clients, and okay, here is what the deal is. And most of them, if they understand what they're dealing with, they will roll with it.
Yep.
You're always gonna have the people who are like, well, I want whatever, doesn't exist. That is not my client. It just isn't, because I just don't have the wherewithal to deal with that kind of ridiculousness. And there are some people who do, but I don't. So it is, here's the deal. Let's work with reality and move forward. And yes, we think it'll come down. How much and when?
Well, let's take a look at the market, Audrey. Let's take a quick look. So it's ugly. We're down 60 today. Clearly, we had to do another alert to lock today. Just awful. I mean, you could see all the way down. We've been doing the lock
Yep.
alerts. Not fun. And
Nope.
the 10-year Treasury is up. But let's just take a look, and let's do a little bit of chart work together. So you could see we have been at these oversold levels. This is a stochastic indicator, oversold for a long, extended period of time. This typically, when you see an extended decline in prices continuing to make lows like this, there usually reaches a point of exhaustion, and you tend to get a bit of a move up. How much of a move up, I'm not sure, but we could see a retracement to around these levels. I presume we are nearing something like that. Clearly, the jobs number on Friday will be very important, but you could see this, over time, where, you get an extended move down like you did here, and then you can get a nice bounce. Then you get an extended move down, and you get a nice bounce. Extended move down, nice bounce. Extended move down, nice bounce. We're clearly in an extended move down. So could it go further? It could. But once you get like these many consecutive downward moves, there tends to be a move up. And it pretty much is in concert with when you get a long period like this on the stochastics, where you tend to like flatline and then boom, you bounce. You get here and you bounce. You get here and you bounce. Each of these does suggest there could be some hope, but it is really painful to go to. And quite frankly, nobody knows if this is the bottom, if we're going further, when is the bounce coming? I could tell you we're closer to getting that bounce than, than we are further than getting that. But, we're in a position where that should start to show itself up. We can get some of these Fed members to not be so pessimistic about it. But again, a big pivot day is going to be Friday. And I think that a lot of traders might take positions ahead of Friday. So it's going to be interesting after the ADP report comes out tomorrow. And this is the 10-year Treasury. When that ADP report comes out tomorrow, depending on the flavor of it, a lot of traders might take positions to say, hey, we're going to buy treasuries and buy mortgage bonds because we think the job number is going to be a stinker. Or people may be taking positions, selling ahead of it, thinking that it's going to be a good number. So watch what happens tomorrow and Thursday. And of course, that's what traders are thinking. Doesn't mean that that's what's going to happen. And then what happens Friday will definitely be a very pivotal day, because look, we have made, it's been a rocket ship from, let's just say 410 to 480, which is where we're at now. That's 70 basis points. That's a lot in a month. 70 basis points in a month. This is trading like an internet stock. You don't see these kinds of enormous moves in the 10-year Treasury. That's a 20%, almost a 20% move in yield in a month. 20% of the yield in a month. Wow. Not quite that much. Maybe it's 17%, but it's you get the picture. So there is room for a retracement, at least down to these levels, like around 435 or so, where I could see If the job number comes out to be a stinker, you could get a bit of a turnaround there.
So if they're expecting, ADP is expecting 150,000 job creations and BLS is expecting 170, do you think it's possible we'll get a bad report?
Yeah, it's possible. The problem that we're getting, Audrey, is that the market doesn't look beyond some of these things. All these revisions that you get, everybody trades off the headline number, then you get all these revisions, and they're like, okay, what's yesterday's news? But the trend is definitely softening. I do have another chart I'll share with you, and I'll pull it up right here so you could see some of the information that we're seeing in the job pictures here. So let's start with this. Let me pull this up in a second. I wanted to just retrieve it first, and then I'll come back to.
While you're pulling it up, we've seen just this first 2 days of the month, huge job losses in the mortgage industry.
Oh my God, it's a bloodbath out there.
It is a bloodbath. It is a sad situation. We want to pray for those people. But look, for example, if we just looked at a month like July, in the July report, due to something called the birth death model, which is where the headline number tends to come from, it's terrible at picking inflection points, but it said we gained 280,000 jobs. However, that was because of something called a seasonal adjustment. We didn't actually gain those jobs. That was a keyboard entry. The actual number of what the tally was. So they tallied up and said, well, in July, we lost 871,000 jobs. But they said, yeah, but seasonally, that really, we this is typically a bad time of the year in July for the summer. So therefore, what we should do is we should make a seasonal adjustment. And they made an adjustment of 1,150,000 jobs. And that's why they said it was plus 280. But nobody looks at this or knows it's a seasonal adjustment, only when you really dig deep under the hood. And then okay, so we gained 200,000 jobs. But that was because there were 900,000 part-time jobs gained against 700,000 full-time jobs lost. This is a 200,000 job gain. But when you look under the hood, it's not pretty. These are multiple job holders looking to make ends meet. And then nobody looks at hours worked, unfortunately. They don't. We've cut a half an hour since the beginning of the year. Now you might say, okay, Barry, big deal, half an hour. Well, on 162 million people in the labor force, that's equivalent to 2 million jobs lost. But nobody's looking at that. And the Fed certainly does not know how to do this kind of analysis. But I wanted to show you this because of the trend. In 2022, we put on 400,000 jobs a month, or 4.8 million for the year. But in the last 12 months, so September of 2022 to August of 2023, we put on 257,000 jobs per month. So we've gone in a 2022 period to the last rolling 12 months, a significant drop. And if you take the last 6 months, what you've seen here is averaging 195. So if you take that and multiply it by 2 to annualize it, it's 2.3 million. And here you see 150,000 jobs a month. You take that for the last 3 months is 450, and you annualize that times 4, it's 1.8 million annualized. So you can see the trend here. And then there's all these revisions that are happening. Everybody trades off the headline number, yay! But everybody forgets about all these revisions. So and nobody pays attention to that. So we're seeing a lot of cracks in the labor market now. Whether they become more apparent in Friday's job number, let's hope that they do. But there's no telling for sure.
All right, that's it. Everyone take a deep breath. Okay, sunshine and unicorns. Let's go. Appreciation, Barry. Appreciation this year, 2023, on all 5 indexes that we watch is looking good.
Appreciation is phenomenal. Can I show you one more chart? Because you did mention that you'd like to see some positivity, right? So
yes, please.
Let's take a look at something that I think can give us a little bit of hope, because that jobs number was a bit discouraging to see, but who knows, we might see it. But let's see.
I need a Xanax right now. So yes, let's talk appreciation.
So before we get to appreciation, I just want to show you this just to give you a little hope on rates. For the last 35 years, the relationship between the blue line on the bottom, which is the 10-year treasury, and the pink line, 30-year fixed rate mortgages, has been somewhat consistent, not exact, certainly, but it tends to gravitate somewhere in the range of 1.75% to 2%. It could go a little above that, a little below that, of course, but around that area. But now, well, let's take a look. Where is the 10-year treasury? We just said it's 4.8, where a mortgage rate's about 7.8. So it's not 2% above. It should be 6.8% now. It is 3%. So what the hell happened that's killed the last 35 years? I will show you. It's the Fed. Now, this has only happened 5 times in the last 40 years, where the pink line that you see here on the bottom is the pink line. This is the 10-year Treasury. The Fed has gone so bonkers that they've raised the Fed funds rate above the 10-year Treasury. Now, that's abnormal. 90% of the time, longer term yields are higher than shorter term yields. Because if I'm tying my money up for 10 years, I expect you to compensate me more than if I were to just have a short term yield. Okay. Well, in the first instance here that happened in the 80s, the Fed went crazy. They raised rates too much. And you see the difference, the pink line above the blue line. What did they do? They wrecked the economy. We hit the brick wall. We crashed. And this is a recession. So the Fed said, oops, let's take that Fed funds rate from 10 and bring it all the way down to 3. So they could change course quickly. And of course, the 10-year Treasury dropped way down. Second instance here, Fed went bonkers again, too high, crashed the economy, recession. Fed funds has to come down fast to correct the damage that they did, and the 10-year follows suit. Third instance, here, again, look at the drop in Fed funds rate, and of course, recession as they crash the economy once again. One more time here. Now, here's where we are today. And the spread, if you notice, is the widest spread. So the Fed has gone crazier than they ever had in the difference between the Fed funds rate and the 10-year Treasury. Now, I want to show you this exact same chart, but I'm going to add one more line, and that other line is mortgage rates. What happened to mortgage rates during this instance? They went from 11 to 7.5. This one, 8.5 to 5.5. This one, 7 to 4.5. This one, 3.5 to 2.5. Now, here's where we are today. So where will we go? We don't know when the turning point is going to be, but when it happens, there is reason to be optimistic that you will see lower rates. You will likely see a recession. You'll likely see, even though the Fed is saying that they're going to be, higher for longer, the jobs numbers come out bad. There's going to be a pivot from the Fed, and hedge funds have $600 billion record that they're holding in shorts on treasuries. So in other words, they've sold these, they've got to buy them back to cover their shorts. They're not going to buy them back now while they're continuing to see prices work in their favor, which means things are getting worse and rates are going up. When they feel that rates have peaked and are headed down and the Fed's about to pivot, this will accelerate the buying. And remember, the spread in mortgage rates and 10-year Treasury will narrow. So you should get a nice improvement relatively quickly when all this occurs. You did say appreciation, correct?
I did.
So I'm going to show you some things on appreciation that we have right now. And I'm looking for the most recent appreciation chart, and here it is. So let's pull that up. Yeah. And I think that you said with all of the measures that we have, Case-Shiller, FHFA, CoreLogic, Black Knight, and Zillow, they're all at record highs. And the August numbers have not yet come out for Case-Shiller, FHFA. They're a little bit delayed, but you could see the yellow. When we hit yellow, it indicates that we hit an all-time high in these measures. So FHFA, the one thing that FHFA does not consider or contemplate is cash transactions. And cash transactions can tend to give people a better deal when they're paying cash. So that's why these indicated all-time highs faster than the other indicators did. But we're looking at somewhere between 0.5%, 5% for 2023 and 8% for 2023. Our forecast is a little over 6%. We did nail it almost on the head last year, and we think we'll be pretty darn close for the year-to-date number this year of what will come in appreciation. Now, remember, mind you, this is when everybody else was forecasting crashes last year, crashes this year. We still hear it. There's just not enough supply. And I know everybody talks about affordability. We hear it all the time. Dan Olick mentions it 8 times a week. But affordability, while it plays a role, let me just see if I could find the affordability slide to pull up for you. If I could find that for you, I think it's revealing. So I'd like to go over that with you guys, because you guys will get it.
Yeah. The other thing is, remember, everyone has a different definition of affordability, just for the record. Like, we walk into politicians' office, and my favorite question at this point is, so what does affordability mean to you? And they get deer in the headlights, and it's just it's a word they toss around like a beach ball. Kevin, what were you going to say?
Well, the other one is the press. They throw out the rate of appreciation in the real estate market is declining. It's like, well, yeah, it's not 20% anymore, but that's not sustainable.
I know.
Yeah, we didn't see 20%. We saw 19% for 1 year in 2020.
Yeah.
And 21, we got 10%. But let me just show you some history on that while I have you. But by the way, on affordability, let's just make it simple. If you used 100% of your income and there was 100% of people who were buyers, the numbers that they use would be valuable. Thing of it is, they say median, right? Now, median includes everyone. So you have the entire population and you take the middle point and you use that income. But that's very flawed. Why is it so flawed? Why has it always been flawed? Because the people here, that 16-year-old working in McDonald's, bless their soul, they're not ready to buy a house today. But if you're going to take their income, you are going to move that median and skew it very, very widely. If you took and you removed, let's just say, the bottom 25%, just to be conservative, now that median moves up rather significantly just by sheer mathematical numbers. If you remove the bottom 25%, the median goes up 12.5%, right? So now you're talking much stronger incomes. It changes the world when it comes to affordability. Plus, remember I said you don't use 100% of your income. That's really critical because according to, this is numbers from Fannie Mae, the average amount of front ratio that's used is about 20%. Heck, say 25%. If it's 25%, that means that what you have to do is, in order to combat a $100 rise in monthly payment, right? You don't have to, if you have a $100 rise in your monthly income, you don't have to keep that consistent. You only need a quarter of that rise in monthly income to combat that in monthly payments. So when you take a look at the variance between the two, and in addition to that, what you do is you look at the fact that the median should be higher, and then you add to that, we get a little lucky with maybe rates come down just 1% from here, and it's a different world on affordability.
Exactly. Yeah. They don't talk very much about how wages are increasing too. So it is
Yeah, that's the thing, is that when you think about, okay, so if your monthly income goes up at 5%, well, let's say it goes up at 4%, you're only using a quarter of that to, yeah, a 4% rise in monthly payment doesn't require a 4% rise in monthly income. It only requires a 1% rise in monthly income, because if you're making, let's just say, $4,000 a month for $1,000 a month payment, that's about the ratio. So 4% rise on $4,000 is bigger than a 4% rise on a $1,000 a month payment. That's the way to look at it.
So we have a comment in the chat from Mark, who says that a client told him a few days ago they need the rate to be below 5% before they buy something. Okay, so yeah, it is. The media is just perpetuating all this nonsense. So
let me tell you what he should go back to, Mark. So go back to that customer and tell him that the 7% rate is the best friend that client could have had. 7.5% is their best friend. The reason is because if and when rates go to 5%, the demand will be so strong. For every one, this is according to the National Association of Realtors, for every 1% drop in mortgage rates, 5 million more people become eligible. Clearly, not all will buy, but a lot of them will enter the market. And you have thin inventory already. What will that do from a supply and demand perspective for prices? In addition to that, he has, as skimpy as the choices are, more choices than if rates were to drop further. And perhaps most importantly, you can always refinance. So let's take this into consideration. I'm going to give you a quick example because it's best if illustrated. So let's take a quick look at something here. I want to show you guys this particular scenario, and I think that this will make it clear for Mark's question. So Mark, when you show them something like this, remember that all these points that I made, but also the National Association of Realtors did a survey, and 39% of buyers cited that waiting for lower rates was the first or second barrier to purchase. So just like you are witnessing yourself, that buyer is part of the 39% who's saying, I'm going to wait for rates to drop. So why is that not a good idea? Well, we could go anywhere, right? I just picked at the market here that has a modest annual rate of appreciation, 4.69% for the year. Nothing crazy. So on an $800,000 home, if you were to purchase it today, and okay, the example I have is 7.25, so maybe it's 7.75. But let's anticipate in a year we get a 1% drop. So the variance is the same. We're talking about a 1% drop in rate.
Yep.
It would be more expensive to buy that today. How much more? $241 a month more to buy it today than if you waited a year and bought it with the lower rate. Now, if you do the math on it, you say, well, the payment's different, but the price of the home would have gone up by that 4.69%. So the mortgage amount would be greater. That means that you're going to take this $241 a month times 12. So I spent an extra $2,900. And then I refinance it. So I got to spend another $4,000. So this thing cost me $7,000, Barry. Why would I wait? Because that 4.69% appreciation on that $800,000 home is $37,000. And the amortization. So you make $43,000 buying that at the 7% rate. And then you refinance the 6% rate later on, pay this money difference, and you still come out $36,000 ahead. Very, 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 very important for us to remember that.
It's huge. And guys, there are those, I don't even know, what do you call them? The modules where you do those calculations are on the MBS Highway website. And by the way, if you're a dingbat like some of us, if you call MBS Highway and ask nicely, they will walk you through it, even with dumb questions being asked. So they're really great about that. So I highly recommend that you check that out, because these are the tools that differentiate us from the call centers, which, by the way, are killing it right now with cash out refis, and I can just push a button and do it myself. No, you can't. You don't even know what you're missing. So be an advisor. That was something, Barry, that you talked about a lot when we heard you speak recently at the NAM conference in Vegas. You talked about being an advisor and being excellent and standing out and elevating yourself. So these are the kind of tools that help you with that. It is so critically important to make sure that you're on top of your game right now so we can stay in it.
I want to show you something else real quick, because in that same survey, 29% of buyers cited competing offers as the first or second barrier to purchase. There's 3.2 offers per home listed, and almost 40% of homes are bid above asking price. So everybody listening, you probably have several pre-quals out there just waiting to buy a home. And so one of them goes out last weekend and they find a home and they really like it. And that's not easy to do because there's not a lot of choices out there. The realtor's thrilled and they're going to make a full price offer on that home. Hooray. But they get outbid. So what's going to be your response? Is your response going to be, hey, I'm sorry to hear that. I'm here for you. Call me anytime if I can be of help. Or are you going to really be a strategist here? And I think as an advisor and as a strategist, what you can go back to the realtor and the customer and say in this exact situation is, hey, you know what? Let's take all the emotion out of it. And let's see, based upon a business decision, if it makes sense for you to bid above asking price and win that home that you really want of your dreams. But let's see if it makes sense mathematically, not emotionally.
Right.
And how do you do that, Barry? Well, we have the ability to see forecasted appreciation in every single zip code. So let's take that exact scenario. And I'm going to bring up a real scenario because we get tons of these that happen every day that people send us. So a 649 purchase price. Now, I know some of you much higher loan amounts, some of you maybe lower loan, whatever. Let's just take this number. The current asking price is also 649. So we know the value. In MBS Highway, we have an AVM that you can pull up in 2 seconds and see. And in this particular case, the home was valued at 649. It's being listed correctly at 649. But in order to win this home, you got to go 10K above asking. And I know sometimes you got to bid more. And I know sometimes you might not get the appraiser to go up that. So I get that there could be obstacles. But in just basic facts here, if you could think about it mathematically, I'm paying $659 for a home that's worth $649. And maybe the customer is quite reasonably reluctant to do that. I can understand. Why would I pay $10,000 more than what it's worth? However, if you would show them mathematically and teach them 2 questions. Question number 1, how long will it take for you to break even? In other words, how long do I have to wait for this home that's currently worth $649 to be worth $659? And B, what does the future look like? And how much appreciation and money can I make over the next few years? So let's answer those questions. So question number 1, how long will it take to break even? 5 months. The forecasted appreciation for this zip code, and everyone's different, is 5.96%. Now, in this case, it's very favorable because I'm going to close in 2 months likely. So that means 3 months after I own it, the home's worth 659. Geez, that's not a long period of wait. Now, sometimes this might say 25 months or 30 months. Maybe it's not worth it. Sometimes it might say 2 months. It all depends on how much over asking price and how much the appreciation is forecasted in that zip code. But now question number 2. Let's look down the road. Now, the 5-year forecasted appreciation is 4.47% average per year. So how much does that mean? Albert Einstein said that compound interest is the 8th wonder of the world. And the reason why I said that is because people can't fathom that this is $158,000. Now, that's at 4.47%. Now, let's do something else. We've got very rich data. Let's go back and see what the last 63-year average per year has been. 4.43, 4.47, almost identical. So we know that this is a good number. Now, watch this. You bid to 10,000, and son of a gun, that freaking competing build, they bid a little bit more. So now you got to go 15,000 above asking price. What happens? That means I got to bid 664. So instead of making 158,000, which would have been here, I make 153,000. Is that a bad thing? Is it still worth it buying that home? Folks, this is helping people get deals done. You do this for a realtor, you do this for a customer. Sure, you and your family benefit by getting the deal, but now you are the hero for the real estate agent. And the days of people throwing deals at us, that's over. We've got to roll up our sleeves. We've got to get creative. We've got to take every single transaction and figure out a way to be the answer person. That's what we have to do right now. This is the biggest thing we need to do right now.
I love this chart, and I've been using it for years. And the other part I use is, well, let's say you don't bid the $10,000 and you lose out and you bid 649. Now, what price do you have to pay for the next house you offer on? Oh, now it's, $15,000-$20,000 more. Boy, you're really going to regret the fact you could have got this one for only $10,000 more.
Kevin, that's so true. That is so true. And then, you get people that get discouraged, that give up. I mean, these are all things that we can circumvent. I mean, you can be the hero for that real estate agent. That's what you have to do. Look, even if you don't actually do a transaction like this, it is so important to explain to realtors that you can, so that your competition doesn't steal them. And so that they say, wow, dealing with Mortgage Pro would be something that if I have a situation, you have answers for me. Somebody else is bringing in bagels, you're coming up with answers and solutions. So this is what we want to make sure we can do.
Just lost Audrey there. Apparently she hit the 12 o'clock mark. But no, I've seen it. And I actually, coach my clients and say, listen, you have to be ready for, that feeling of rejection when you don't get that first offer.
Yeah, for sure. For sure.
Here she comes back again.
We missed you.
Timing, Audrey.
Oh my God. I didn't even have a chance to make my snarky comment about, like forgetting about the idea that maybe you're about to have your 3rd kid and you can't squeeze it into your 2-bedroom condo. So you need to buy a freaking house. But anyway, did I miss anything else?
No, but that's, you're so right. And that's something that, we didn't get a chance to do this today, but one of the things that you need to consider doing is the number one, that we have 400,000 real estate agents that we survey. And, thanks to our acquisition of list reports, we have the data. And the number one problem that they're facing right now is the person's got 3.25, they're going to 7.5. And it's a bridge too far to make that difference in monthly payment. So what can we do? Clearly, we're not going to solve for every one of these, but we can from time to time solve, and a lot of chances to do so, by looking at their debt picture. And instead of the way that people normally purchase a home, I sell it for this, I owe this, and then I take out my closing costs. So I have this, and I'm going to use this for closing costs on the new home plus down payment. Don't put all that money down. Take a good portion of it, pay off all your debt, consolidate it, and then use this for your down payment. You'll discover that in many cases, the difference is shrunk to very, very little or easy to manage, sometimes depending on your debt, even cheaper than what you're making monthly payments today. So you have to be a strategist. You have to be a debt manager. You have to be an advisor in today's market to win. So I know we're coming up on time, Audrey. So
yeah, no,
anyone who asked about charts and such, if they watch the replay on YouTube, Mortgage Pros 401 YouTube, you can catch the whole thing all over again.
And guys, we have Mark Calabria with the CFPB joining us next week. It is literally just live, no YouTube, no recording. I mean, God forbid anything should be posted publicly about what they're saying, but it's always great to hear from him. He's absolutely wonderful. And bring your questions. Let us know ahead of time what you want to know from the CFPB. And Barry, we adore you. This was great. And I just want to throw in this last thing. You have an amazing example of what you can do for someone who has debt, and you take their current mortgage, yeah, they're at 3%, blah, blah, blah. And you take that savings and you turn it into them paying off their house years earlier and being debt free. It's magic. So we'll have to cover that on a different show. But otherwise, thank you. We loved it. Wonderful comments from everyone. Really appreciative for all your input. Have a great day. We love your new look. You look very young and clean shaven. My goodness. All right.
I'm not going to grow it back till rates come down to a more reasonable level.
Oh, is that? Oh my God. You're like a
Trying
baseball player.